Setting up one or more IRAs can be a great way to set yourself up for a more secure retirement. By learning the tax rules governing IRAs, you can maximize the benefits of these special accounts while avoiding common mistakes. This video explains the essential differences between the two main types of IRAs, known as traditional and Roth, with some tips on choosing the best plan for you. Officially, IRA stands for Individual Retirement Arrangement, which is the language used in the 1974 law that set down the original rules for these plans. However, it's much more common these days to use the phrase individual retirement account, since that's exactly what an IRA is. An account created by an individual to set aside money for retirement. Some workplaces offer personnel the opportunity to establish an IRA as part of a benefits plan. Most often, however, taxpayers set up their own IRAs outside of their employment context by working directly with a bank, broker, or other financial services company. Typically, an IRA is an investment portfolio, which means that the account is made up of some mix of cash, stocks, bonds, mutual funds, and so on. Those details are usually under the control of the account manager. As an IRA owner, you simply make deposits to the account, called contributions, to build up the account balance over the years. Investment returns like bond interest, dividends, or rising stock values will also boost the account balance over time. Down the line, you can take withdrawals from the account, called distributions, to provide yourself with retirement income. The original idea of IRAs was to offer taxpayers a tax-deferred retirement savings plan, meaning that the need to pay taxes on income is pushed off to a later year. IRAs that still follow this basic model are called traditional IRAs. Here is how these plans work, at least in theory. When you make contributions to your traditional IRA, you do not have to pay federal income tax on that portion of your income. When you receive distributions from your traditional IRA later in life, those distributions are generally taxed by the IRS as ordinary income. So the income you contribute to your traditional IRA is not exempt from federal income tax, but the taxation is delayed. If you open a traditional IRA when you're 30 and don't start taking distributions until you're in your 70s, you could defer tax on some of your contributions for over 4 decades. Again, all of this is the theory behind a traditional IRA. In practice, not all traditional IRA contributions actually qualify for tax deferral. To make sense of when this tax advantage is available and when it's not, we need to dive a little deeper into the IRS rules and how you report your traditional IRA transactions on your tax return. Once you have set up a traditional IRA, you may be able to claim a deduction on your tax return each year for any contributions you make to the account. For example, suppose that Sarah's gross income for a certain year is $62,500. She contributes $4,500 of that income to her traditional IRA. On her tax return, Sarah claims a deduction for this contribution, reducing her reported income to $58,000, as you see here. Federal income tax applies only to your taxable income, which is the amount of income remaining after you subtract away all of your allowed deductions. Therefore, Sarah would not pay any federal income tax that year on the $4,500 she contributed to her traditional IRA. Importantly, the deduction for traditional IRA contributions is an above-the-line deduction, meaning that you can claim it regardless of whether you itemize deductions or take the standard deduction. Now, I said a moment ago that you may be able to deduct your traditional IRA contributions on your tax return.